Hi there, everyone, and welcome into this week's market update. Don't forget that any advice contained within this presentation is general only, so it isn't tailored to your particular circumstances. You need to decide for yourself whether it's appropriate to you. All right, so our market today pretty much closed flat, maybe a few points higher. From last week, though, what has changed? We fell off from 68 and came tumbling back down to our lowest level of 2022. We're basically testing that level at the moment, seeing a little bit of a bounce off there for the second, and just see where we want to go from here. Technically, look, guys, the market's very, very oversold now. So, probably thinking we will see a bit of upward movement from here is very likely, or a bit of sideways. Now, if we sort of go back and have a look at what happened last time, market came off, went sideways for about a week, and then pushed up back near 68 again. I suspect perhaps something similar will happen. Okay, given the seasonal pattern that we see usually around this time of year, as well as basically, I think markets may have priced a lot of this interest rate stuff in for the moment, okay, in the short term. But yeah, it's too early to call it, guys. Okay, I think the market's still a bit shell shocked. Okay, fallen off quite a bit, but all in all, okay, come back to some key levels, looking very oversold. If we have a look at our market, we're about 15% off the all-time high, and the recent movement we've seen from 7,000, where we topped out, down to where we are now. We're very close to a 10% correction from the highs back in August. Most importantly, though, let's keep an eye on the S&P 500. The S&P 500 is probably really what the leader of everything at the moment. So if we go from their all-time high down to where they are at the moment, we're looking at 24%. Same deal as our market. They're back to their 2022 lows. Look, the big thing here, guys, is if this level holds, it could be a double bottom, right? Way too early to tell. 43 would have to break, but people will speculate on that. So it is important to talk about. So a bounce off here, people will speculate this could be a double bottom. A breakthrough, though, we're reconfirming the downtrend, and really for me, 32 is the next target. So look, things could get nasty from a technical standpoint if this level breaks. So let's just see. Okay, we're testing right on it at the moment. The futures are a little bit higher, back up closer to 37. Okay, so that's indicating perhaps a bit more sideways or over the next few days, maybe. But yeah, that's the key level, guys. Now, if we also have a quick look from, I guess, where we peaked here, okay, they've done more than a 10% correction since this peak. So look, these big sweeping moves, the fierce selling moves tend to hang around that 10% amount, right? 10 to 12%. So markets oversold. I think people are going to be speculating and buying up over the next few weeks coming into that reporting season. All right, as many of you already know, what sent this round of selling into markets was the Fed announcement last week. They lifted rates by 75 points again, bringing them up to about 3.25 to 3.5. Now, the bond markets are expecting 4.4 by the end of the year. Jay Powell came out and threw the number 4.6 in the air, and that rates could go as high as 4.6 in the early quarter of next year before they come back down again. So for me, look, negative, right? Because the markets were expecting that rates perhaps were getting close to a top, right? But now, rates are going to be higher, and they're going to go higher for longer, guys. Okay, people are expecting rates to come back down by first quarter of next year. It's likely to be maybe second half of next year, right? Might be the year after. We just don't know. But I think where the markets are pricing at the moment is rates are probably going to top out more so towards the end of the first quarter next year. But they're going to probably get to 4.5, 4.6. Okay, so that means, come November, which is the next Fed meeting, I think it's like 1st or 2nd of November, probably going to get another 75 points. Okay, and then maybe another 50 points at December, and then between December and the next meeting is quite a bit of time. I think it's February by the time they meet again. So have a think about how the market's going to react to all of this, okay? We just had the Fed meeting. We just had a CPI reading. That shocked the markets. The next CPI reading's not for another 3 weeks. So between now and then, what's the market got to focus on? We already know what rates are going to be for the rest of the year, Okay, so once the markets have priced this in, then what's next, guys? Okay, so how long is it going to take the market to price this in? That's what we're going to be asking from a trading standpoint. Markets have fallen. They fell into the Fed announcement. They fell after the Fed announcement. So where's the bottom of this move? And once you find that, well, perhaps markets have priced it in for the time being. And then markets will start, or investors and traders will start focusing on reporting seasons and other things rather than the Fed, because we're not going to hear from the Fed again until November. We're not going to see another inflation reading for another, say 2.5 weeks. So the markets in the short term are probably going to quickly switch, I think, from bearish to maybe a little bit sideways to bullish for at least 2 to 3 weeks here, guys. And what they do from there will depend on the next CPI reading. If the next CPI reading comes in high again, the markets will sell off. There's the danger of breaking below those support levels I was talking about earlier. I don't think we're going to get through them this time. I think we're going to have an uplift into reporting, and then whether the next CPI reading is high or not will dictate whether we're going to go into lower levels and go further into a bear market. Okay, so I think we've got to be cautious here, guys. I wouldn't be going short. You've missed the move. Wait for the market to bottom. It's going to come up again. And what it does after that's really going to depend on maybe two things: the CPI rating and how well the companies report come that October reporting season. And so reporting's around the corner, guys. Look, as a rule of thumb, interest rates don't really get felt by economies and markets for about 6 months. Okay, we started lifting rates roughly 6 months ago. So this reporting season is going to be fairly important to see what, if any, if real massive effect it's had on company earnings. And in fact, for me, it's really the January, February reporting season is going to be most important to see. The interesting thing in this conversation, guys, is, at the end of the day, markets tend to price a recession in before the recession happens. Okay. US hasn't come into official recession yet, but if they do this quarter, deem it as an official recession, perhaps markets are close to the bottom, right? I'm not going to tell you where the bottom is. Nobody actually knows. There's too much going on here. But I can tell you guys, I kind of feel we're close to it, right? It comes down to this CPI rating. I think the biggest thing for us right now is that CPI rating, the next two or three of them anyway. If they keep coming in high, the markets haven't bottomed, right? But if we see CPI just chill out, just find a level, just go sideways, starts showing some sign of easing, then we're fine, okay? Looking at the reaction to markets for the last few Fed meetings, guys, okay, we've had a huge correction in crude, okay? Crude was up near 110, now down to 77. Copper's come down a lot. Most commodities have. Some of the gas markets are staying a little bit elevated, but they've come off quite a bit to where they were when the first part of the Ukraine war started. So from a commodity standpoint, pressure's coming off. Okay, the pressure that we're seeing at the moment on inflation, a lot actually has to do with labor demand and wages going up and companies just in general putting prices up. Right, it actually hasn't got much to do with COVID and the likes of the COVID situation and the likes of Ukraine-Russian situation anymore. Okay, the inflation's sort of grown its own legs at the moment, and basically we're going to see where it's going to end. Okay, let's see whether what central banks are doing can actually stop inflation from continuing to go up. Yeah, but look, at the end of the day, can markets move lower? It comes down to how hard a landing we see out there. Locally, I think we're actually okay. Sorry, the phones are ringing like crazy all of a sudden. You know, our economy will probably weather a lot of this quite well. Okay, our housing market won't, but the economy will. We're a good exporter. We're a strong exporter. So I think we're okay from that perspective. The US, though, definitely a massive consumer market. Okay, they're the ones we've got to watch out for, which means, and that's why you're seeing the growth stocks fall so much. That's why you're seeing the US tech stocks and discretionary stocks fall so much, right? The US is at the higher risk of the recession side of things at the moment. Depending on how much of a hard landing they go for, guys. If it's a fairly soft recession, then it's okay. If they go for a much harder landing, like people are fearful of, well, markets can move much, much lower. People are going to be speculating on that depending on inflation. If inflation keeps going up, they speculate that the landing's going to get harder because interest rates are going to have to go up higher. So that's the key factor here. I keep repeating myself, and I'll continue to do that. Two things you're going to be watching out for risk in this market. I look at the 10-year US yields. Those yields are up at near 4%. If they steady off there, I'd become a little bit bullish short term. If they keep rising through 4%, the markets could easily go lower. So keep an eye on those bond yields, guys. If bonds continue to sell off hard, and we continue to see yields climb like this, markets could break lower, right? That's one. Two, I've said it 3 to 4 times this video, CPI readings, guys, okay? We need to see that inflation come off a touch, right? If we see that, especially the US CPI readings, if we can see that starting to come down, and not continue to push higher, I think markets will be happy with that. So 2 majors that you want to be watching, okay, at this point of time. All right, I'll leave it there. Thanks for listening in, guys, okay? Got my view. Hopefully things calm down a bit, and we hold this as a bit of a bottom for the time being anyway. All right, take care. Bye for now.